Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, May 9th, 2022. What I'll do is a brief update on the equity markets as well as some of the other trade ideas I've highlighted recently, including Treasury bonds, natural gas. We'll look at crude oil and maybe gold and silver if we get to that. But most important is the equity markets. We have now hit that fully hit T2. T2 was from roughly 299 to 300, and we've hit a low today so far of 298.93. So every bit of that. It is support. I wanted to point that out, and that's why it's a price target. Support level I believe would be hit, and again it's about, what did I say, about 25% gain. Here are our short entries. The first one was here on the break of that. It was really on the 60-minute chart, break of that trend line, and we added there on that break every push back to the 400 level. And so average in, it's close to 25% gain, but it's well above that. I mean, my profits trading the Qs this year are many fold that, because we've had multiple objective areas to cover, reverse and go long, and then reshort back again as an active trader. But I know that's not in everyone's skill sets. I try to do my best to get those levels out in advanced and or real time, but here's where we're at now. So I wanted to say that we are at support on the NASDAQ 100. It is pretty good support. I'm going to just say this right up front. Here's the point where the markets are. I use that rubber band analogy. The rubber band is very stretched. What I mean by that? Well, we're oversold. Look at the RSI down here at the very bottom of the screen. We're at 31 on the RSI. 30 is oversold. And on the weekly chart, especially in a bull market, which by just about every metric, it's still a bull market. Make no mistake about it. It doesn't matter if the NASDAQ dropped over 20%, which it has. That's the old antiquated, it's not my definition of a bull or bear market. This is a bull market uptrend line, still my target. I believe we'll come back to one or two of these. I have alternative trend lines in the 2015 high. I'm sorry, what am 2015? The two COVID highs, the March of February of 2020. But it's just a matter of how we get there. And now, so here's again what I wanted to say. We're at the point we are very oversold, and the last time we were that oversold was again when at the bottom of the COVID lows right there, right? Before that was that fourth quarter drop in 2018, right about where we are now. We came just a hair above the 30 level on the RSI, and both of those proved to be golden shorting opportunities. So with the rubber band being stretched, what happens is when it gets very stretched, rubber band, it often snaps back pretty hard, right? The more stretched, the more the harder the snapback. Things are different this time. This time the Fed pulled a 180. They started going hawkish. The market threw a fit. They went dovish again, put it back down. Or no, I'm sorry. That was back in 2018. Of course, when COVID hit, they couldn't have gone any more dovish than that. This time we're in a rate hiking cycle with more to come. So again, the rubber band, if you pull too hard on it, it will eventually snap, and that's where we're at. We could very well snap here. And for the reasons that I mentioned before, I'm going to get to the sentiment in just a second here. So again, up to you how you want to trade it. If you're happy with those gains, take your profits, sit back. You could even take a shot at going long. I gave you some charts. I'll get to those in a second that you can watch. It might trigger a rally today. But we're at that, I believe we're at that point of recognition in the market where all the bulls, which are the vast majority of market participants, are realizing, wait a minute, something's wrong. I keep buying Apple, I keep buying Microsoft, I keep buying the Qs, I keep buying the Peloton and every other stock that's come down, crash, Facebook, but the market keeps going lower, and eventually they throw in the towel. Dip buyers stop buying the dip, and when you fail to have buyers stepping in buying dips, especially when there's that capitulation, that's when you can get a big drop. So there it is, guys. I'm not giving you wishy-washy analysis. I'm telling you, I still maintain these targets, and I think if we're going to break, now is probably the time we really snap, because again, primarily because very few, if any, expect it. That's where I think the big drops come from. If everyone's expecting it, it doesn't happen. Again, I'm going to get to sentiment in a second. So there it is, T1 hit. However, S&P 500, we're still a little bit above my near-term second target of 394.50ish, and I still maintain these longer-term targets. At least that T1 right there. Again, that's the nope. The pre-COVID highs right there is about where that T2 is. So kind of a range where I think we're going, and we could get there quick. Something I've covered many times. I'm trying to rush through this video to get it out to you, but I made a point to get you guys some charts out this morning. So I know that's always been a request when the markets are moving fast, because you don't always have time to watch a video. But there's a big thin zone right here, and I'm talking about these volume at price histogram bars where they are real short. And so that says once you enter a thin zone, you can backfill it pretty quickly. So that's that. So another way to put it, it's kind of do or die time where, there's still some support on the S&P 500 here. Remember, the QQQ is at support. So it can very easily do what I call momentum fueled overshoot. You get that when there's a pretty strong down day or pretty strong up day. Let me just turn, that's the wrong one. I want to turn that price histogram down. Meaning you can overshoot the QQQ support, but if SPY holds at or near and bounces, then QQQ can recover and end the day back on or above that support. So the other one is IWM. Been pushing the small caps and the NASDAQ 100 as my preferred shorting indexes. Remember, we shorted those back in November when both peaked. So we've milked, even as a trend trader. If you were gaming the shorter term bullish and bearish setups and bounces back to resistance, it's a magnitude of gains higher than this. But so far that's been a 28% drop. So if you were shorted anywhere, well, even down here, this was a big sell signal when IWM broke there. And so if you even go by that, and we had multiple what I call golden short ops when we bounced back to that 209 level, and it's been 16% from there. I'm going to loop over to these 5-minute charts. This is what I showed you, put out on the last post. Here's some trend lines that are pretty well defined too. So keep an eye on that. This is the NQ. You have 1, 2, 3, 4 distinct reactions. This I was just showing. These, forget those arrows. Just look at the downtrend line. The divergence is still intact. We pushed, made a little bit lower low since I gave you those trend lines. We were right there, but we still have divergence there. And keep in mind, we still have divergence. Well, let me get to the other 5-minute chart of RTY. There it is, same thing, 5-minute chart. 1, 2, 3, 4, almost 5, 6 distinct reactions. So you see your downtrend line. If you want to replicate that, that comes from what is that, May 5th, I think, right down there. And then ES, the S&P 500 futures, that's where I got it to you right here. We went a little bit lower since then, but we still have holding on by the skin of our teeth, but there's still positive divergence right there. And you also can see a nice former support, now resistance level. So these are just things to watch. If we have an intraday rally and we can pop both the trend line and that, then that should open the door for move a counter trend bounce. And it will also, remember, if this happens, it means we're going to have successfully defended those support levels on the daily charts, particularly QQQ. So that's kind of the state of the union for the markets right now. If you don't know what to do, then the best thing to do is to be in cash or flat, at least from the indexes, and watch from the sidelines, especially if you're new to trading, because this is the time you're either going to make a lot of money or lose a lot of money if you're on the wrong side of the trade, because volatility is high right now and the markets tend to move very fast and big. Okay, so there it is. Getting close to that first target on IWM right there. Remember QQQ, I'm sorry, second target. QQQ second target hit. Let's walk it down to the daily charts. Still, at this point, have the divergence. Although, remember, we got rejected. We looked like we were going to make a bullish cross there. Never did. And these indicator, it's a PPO is a momentum indicator, as is the RSI. They're still pointing lower. So if those divergences get taken out, that's going to be pretty darn bearish. But they're still in place, and that gives us a potential for more than just like an intraday bounce. But if you look at the daily chart on IWM, right here, it's about 188 or so. That would be a potential bounce target minimum, and if the divergences play out, it could be even more. So like I say, stay flexible. Don't be married to any one view that the market must do this or must do that. I tell you, I speak in probabilities, not possibilities, because anything's possible. Keep in mind too, when you go to the daily chart, which I just did on QQQ, you have nice reactions along this level. That also aligns with my second target on the weekly. I have it here at 298. You can see. So really, when you go to the daily, you can get in a little sharper and hone in on that target. Again, lots of reactions on 298, and so the buyers can step in here, and if they do, even just a seemingly minor, bounce has the potential to firm up the charts by putting in divergence. Because I made the whole analogy or comparison to 2008. And things don't always play out. No two bear markets always play out the same way. So far, the parallels are uncanny, I think, but here, let me jump over to SPY real quick, show you what that looks like in the daily chart. SPY support on the daily, I have coming in here. One reaction there, not a lot, about 397, and we're close to it now. Again, potential to put in that divergent low, also the potential to take it out. So that's it. Right now, bears are in control today. Obviously, we're down 2.5% on SPY. Nothing major, but again, where we're at, it just builds on the recent losses and breakdown. And all right, so that's it. Watch those charts. Watch those intraday charts. If you're an active trader, you already know what to do. You look for things such as any signs such as the bullish reversal patterns, engulfing candles, things like that on the 5-minute charts, 15-minute charts, and things of that nature. Bearish, bullish or bearish PPO crossovers. Let me get to the other ideas, or we'll never wrap the video up. All right, let's take a look at the VIX real quick. VIX futures. We've been putting in divergences, but we keep punching higher, and that's kind of, again, remember, the VIX is just like the stock market in reverse. So that's been typical so far of bear market action in the stock market. We keep getting divergent lows. They play out for a little pop, it gets sold into, and you keep going lower, 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 and but you gotta realize that as with those divergences in the equity markets getting bigger, they're getting bigger here in the VIX, and if they play out, it's going to play out and coincide with a rally off these support levels. So that's it. Again, you might want to go long if that happens, or go long here. We're at support on Qs. Go long with a stop not too far below. If the markets are going to break, they're going to break now and probably melt down this week. And if not, buyers are going to step in, defend that support level, and we could get a tradable bounce. So that's it. Big level, pretty much a decent level there. It was that previous high. We popped it twice right here so far in the VIX. These are VIX futures. If I didn't make mention the May contract, these are going to roll soon. And then if the market rallies, the VIX probably come down pretty good. It usually does. All right, other things to look at. Remember, the markets are not everything, nor should they be. I love trading them, but they are just one piece of the pie. This one's been nice. I mean, when you trade things like natural gas and crude oil, especially when they're volatile, you can make in a single day. I mean, this is basically a one trading session gain already of what did I say, 15%? What was that? Yeah, about 15% from where we shorted it on Friday. Put it as a setup here. We broke down, triggered it. Look at that perfect action. Look at that. Boom. Hit that. And the last chart I gave you on Friday, I had updated and put a yellow line there I thought was significant. And we hit it and we bounced off it. And then last night it provided a nice reversal point. We bounced back to that first target. My first target was 158. And then a rejection there, a little bear flagging action. Look at that. Boom, boom, boom. Hit the trend line. Gives you a chance to cover today. And again, I gave you also a daily chart. So if you want to hold out for Oh no, that's 2 hour. If you want to go for a longer trade, you certainly could, or take profits here, or even reverse as an active trader, because there it is. We are at the now at the uptrend line, which is the same one that was my initial final target on the 60-minute chart. So I think we'll probably get a bounce, because usually when you have a wedge, it needs to develop a little. So bounce up to there, and take a long. Of course, don't hold it if we break down, and especially on a daily close. But you probably get a bounce trade out of it now, and then reshort or add to on a bounce back to resistance up there somewhere, right around that level, about $8 or so, and then short. In that time, I'd probably just hold out for a breakdown. We'll probably get the breakdown in natural gas, but either way, or you just take the 15% in less than a full, or just over a full trading session. Counting from when we broke down Friday, take the money and run. And at least one person I saw in the comment section had cold, spotted the divergent high, got stopped out once, but got back in. And look at that. It's, since the breakdown, which was right about here, cold's good for, obviously, it's about exactly what I just said, twice 15%. It's a two-time inverse, so natural gas futures dropped 15, cold since the breakdown, not from the lows, but from where our sell signal was about a 30% gain. And look at that, big old gap. So why not take the money and run right now, get a pullback or game a pullback trade, short cold or buy Boyle, I think is the other one, right? Boyle, B-O-I-L, if you trade ET, yeah, there it is. That's the two-time long nat gas ETN. So that's active trading for you. All right, guys, we covered the markets. We covered natural gas. Let's do crude oil real quick. CL. Crude oil will likely see demand destruction and is going to start trading, I believe, in line with the market. And so far it has. We put in a little divergent high here. This is a 60-minute chart right there. You can see 3 months price history. And we failed. We've broken. We have a failed breakout now right here, this whole thing of that triangle pattern I just drew. There's a triangle. We went back in it. We took out the 106.30 level, moving down. There'll be probably some zigs and zags along the way, but we'll probably come back down to the bottom of the triangle now, would be my guess, in crude oil. Again, coming off that divergent high. Last divergent high was there. Previous before that was there. And you see what happened on those two. Divergent high. Yeah, almost divergent high, about equal highs there. We actually, we shorted it there. I pointed that as a short on crude. Okay, Treasury bonds. Treasury bonds. This is a zoomed out recently. I showed you on Friday, I believe, these 2-hour charts where every candlestick's 2 hours, so it's 6 months of trading history. Nice fat wedges, and if the market continues to come under pressure, you can see today a nice lift in treasuries with the sell-off in equities, because you're getting that flight to safety twofold. The benefit should be flight to safety, institutions selling stocks, moving into bonds, and also, more importantly, I think, the quickly diminishing expectations for economic growth. When your stock market goes down, especially goes down hard, it implies people are then bearish on those stocks and their earnings forecasts. They're selling. At least that's the common wisdom, whether it's forced margin call selling or not. And so therefore, the stock market goes down, and no matter for what reason it goes down, it's going to take away consumer confidence. Remember, the NASDAQ is now down 25% off its highs, and that's where a lot of people have their money. The S&P is, I haven't measured it, so I know last week it was 13%, so it's got to be over 15% off the highs. And that's going to have an impact on consumer confidence in this whole pillar. Every bull out there I hear, their one thing is, the consumer's still strong, the consumer's holding up. And yes, they're spending. And until they stop spending, the economy is not going to really turn or go down much, especially with full unemployment. However, consumer sentiment, is can change on a dime. And you take a 15, 20, 30 plus percent drop in the stock market, and you're going to see the consumer change their habits pretty darn quickly. And think about it, you're not going to read about that. You're not going to see the monthly economic indicators, consumer sentiment and consumer spending and all that good stuff. That stuff's going to come out well after it's already turned. It doesn't take a rocket scientist, again, to know that a 30% drop in the stock market is going to have people pulling their shell. A lot of people are buying new cars, new boats, moving up to a nicer house and buying all kinds of discretionary items because their 401ks have just exploded up to the upside since COVID, and not to mention all the government stimulus checks in their hand and all that. So that's all getting taken away. So there's my point is, and that's where I think a lot of analysts just don't get it. They're based on, oh, okay, as of now. I look ahead. I don't look in the rearview mirror, and I think that's what fundamental analysis is all about. It's looking in the rearview mirror, looking at past economic data and reports that have a lag anywhere, usually at minimum a month. On a lot of those, some are quarterly. Same thing with earnings from corporations. They report quarterly earnings 1 month after the quarter is over. So that's information that's up to 4 months old from the beginning of that previous quarter, and finalized at the end of the last quarter. And so a lot can and will change. So anyway, that's it. So let's just keep in mind this: whether the bonds finally break out and have a big run is not. It's absolutely not completely contingent on what the stock market does. They can do their own thing. Lately, oddly enough, stocks and bonds have been positively correlated. They've been going down together. That's rare and not often unseen. And remember, the other counter headwind to my thing about if the stock market goes down more, how you should see diminished growth expectations and a flight to safety. Well, on the other side of that, and this is important, we now have the Fed gone from quantitative easing to quantitative tightening, meaning they're selling off their bond holdings. That's a pretty big seller. So anywho, that's levels to watch on the bonds. They haven't yet broken out those above the trend lines. Well, let me give you ZB, 60-minute, there's your trend line. 30-year bond, I was on the 10-year right here, that's ZN. And then ZF, the 5-year. The 5-year, I'm going to tweak this trend line right now to come in line with that previous reaction, put us about where we're at now. And I think that's it. Gold kind of hanging in there. I'm not happy with the action in gold. It took out this near-term uptrend line, still above that recent low, which was a divergent low right here. So as long as we can hold above there and rally, there's a potential to keep an uptrend going. But again, it's just been every time it starts to break out of these divergent lows and trend line breakouts, it keeps getting sold into. But for now, I'm sticking with it because it's just part of my diversified portfolio. Having long gold, long treasury bonds, short equities, but ready to turn on a dime on that. And I've already covered since before this video. I've covered up some of those short positions because the QQQ is at that big support. I'm not gonna be staying long heavy, and probably about a 50-50 chance by the time that you listen to this video, I might be long in the equity markets based on everything I just showed you, the developments on the short-term charts, intraday charts, combined with support on the daily chart and divergences on the VIX, everything else. All right, let me get it out to you guys, and yeah, if I see anything else that stands out, I'll let you know, but those are the big things. And remember, stay flexible. Don't get married to any one bias or outlook that the market must do this or must do that. And I'd really be eager to see how we close the day today. I think that can be quite telling as to whether we're going to hold and bounce off these, this support levels in QQQ we're at now, or have, consider more downside, maybe take out T2 and head all the way down to the third target soon. This has been Randy Finney with Right Side of the Chart. Have a great day.